Imagine a future where algorithms don't just predict the weather, but actually predict cures for diseases. Sounds like science fiction,
It
right?
really does. Pure sci-fi territory for most people.
But what if this isn't just some distant dream? What if it's this, well, audacious, multi-billion-dollar bet a company is making right now?
A bet where success or failure hinges on whether tech can genuinely outsmart biology. It's fascinating.
Exactly. Today, we're diving deep into a company right on the bleeding edge of that future. They're facing, immense promise, but also some formidable challenges.
It's a story of big innovation, huge ambition, but also, let's be honest, some pretty stark financial realities. Really paints a picture of a market in deep conflict.
We are talking about Recursion Pharmaceuticals, NASDAQ ticker RXRX.
RXRX. Got it.
And our mission for this deep dive is pretty straightforward. Unpack Recursion's complex world, cut through the hype, cut through the financials.
And give you, our listener, a really clear understanding of this tech bio pioneer.
Yeah. We're working from an in-depth value investing analysis dated September 2nd, 2025, using a share price back then of $4.70.
Okay, $4.07. Good reference point.
So let's break this down, kicking off part one of our deep dive. Chapter 1, Business Analysis.
All right, chapter 1.
So in the traditional world of drug discovery, I mean, the stats are just brutal, aren't they?
Oh, absolutely brutal. Something like 90% of clinical trials fail.
90%. And the cost, it's over $2 billion, maybe more, for a single approved drug.
Easily. It's incredibly risky and expensive, which really makes you wonder.
Can an algorithm cure disease? And maybe more importantly for investors, can it cure a portfolio?
That's the multi-billion-dollar question Recursion is built on.
So Recursion is placing this massive bet that, yeah, it can. Their business model, it's kind of multifaceted.
Right. Long term, the big prize is developing and selling their own drugs, capturing all that value.
But for now, and this is really critical, they rely heavily on strategic partnerships. Think big names like Bayer, Roche, Sanofi.
These deals are crucial. They give Recursion's tech external validation, which is huge. And maybe more importantly,
They bring in non-dilutive capital, right? Money that doesn't water down existing shareholders.
exactly, it comes through upfront payments, funding for R&D, and these success-based milestone payments.
Like that Sanofi deal they mentioned, $130 million from just 4 milestones over 18 months.
Yeah, but here's the catch, and it's a big one. These milestone payments are unpredictable. They're lumpy, as they say in finance.
And that's vital to understand because Recursion currently has no recurring revenue from selling actual products. Zero.
Their entire financial performance, for now, hinges on hitting those milestones. Very different from a company selling widgets every month.
So their key product, then, isn't really a drug yet. It's the engine that finds them.
Precisely. The Recursion Operating System, or OS, that's the crown jewel.
Okay, tell us about the OS. What's in it?
It's this integrated platform that basically industrializes drug discovery. It combines automated robotic wet labs.
Robots doing the pipetting.
Yep, millions of experiments a week. Then advanced imaging creates these high-dimensional cellular maps they call phenomaps. And machine learning, Vidishim, Risaya predicts chemistry and biological relationships.
Millions of experiments a week, generating petabytes of data.
Terabytes weekly, yeah.
Yeah.
Adding up to petabytes, 36 petabytes of proprietary data last time I checked. Mapping trillions of biological relationships.
Wow. And from that engine, they've got a pipeline of actual drug candidates moving into clinical stages.
They do, primarily focused on areas like oncology, so cancer and rare diseases. Names like REC-4881 for FAP, REC-617 for solid tumors, others for lymphomas and B-cell malignancies.
Okay, but here's where it gets, well, tricky, right? Because drug discovery is tough. Remember those advanced candidates, REC-994 and REC-2282? What happened there?
Ah, yes. That's a key point. Early in 2025, Recursion did a pretty significant strategic realignment.
Right, they discontinued several clinical programs, including some of those more advanced ones you just mentioned.
Correct. They framed it as a strategic, data-driven review to focus resources on programs with the strongest scientific rationale.
Which sounds logical, but it definitely highlights the risk. We'll circle back to that when we talk about management.
Definitely worth revisiting. It shows the volatility inherent in this space.
So Recursion positions itself as a leading clinical stage tech bio company. Kind of a hybrid, right? Tech meets biotech.
Exactly. Market cap around $2.5 billion based on that $4.70 share price. They grew fast, especially after merging with Exscientia, now about 800 employees.
And they talk about this bilingual workforce, life scientists and computational experts working together.
Which is crucial for their model. their big value proposition: decode biology to radically improve lives.
By basically re-engineering drug discovery economics, trying to fix the long timelines, the high costs, the high failure rates.
By industrializing it with the Recursion OS, replacing slow, biased trial and error with a faster, cheaper, hopefully more predictive system using all that data and machine learning.
Okay, so how does this fit into the wider industry landscape?
Well, it's a booming market. Global biotech is projected for huge growth, like $1.77 trillion in 2025, potentially hitting $5.7 trillion by 2034. That's like a 14% compound annual growth rate.
Wow, what's driving that?
A few things. Rising global healthcare demand, definitely. But also this convergence of tech, AI, and machine learning with biology, plus advances in genomics, precision medicine, and just tons of investment, both government and private.
But it's not like Recursion has the field to itself, right? Competition must be intense.
Incredibly intense. They face direct competition from other AI-driven drug discovery firms. Schrödinger, Atomwise, others.
Okay, the other AI players.
But maybe even more significant is the competition from within big pharma.
Huh.
Many large companies, including some of Recursion's own partners like Roche and Bayer, are building up their internal AI R&D capabilities.
Ah, so it's co-opetition, as they say, competing and cooperating at the same time.
Exactly. And that, plus the broader field, threatens Recursion's pricing power and maybe makes it harder to sign new, favorable partnerships down the line.
What about regulators? How are they handling AI in drug discovery?
It's still pretty new, nascent, but definitely evolving fast. The FDA is actually being quite proactive. They set up an AI council, issued draft guidance in early 2025.
So that's good, right? Validation.
It's a double-edged sword. On one hand, yes, it validates the approach, but it also means potential new hurdles, new compliance rules, maybe longer timelines for validating the AI models themselves. It could slow things down a bit.
Okay. Despite the competition, you mentioned barriers to entry. What are they?
They're substantial. First, that proprietary data moat. We mentioned 36 petabytes, building that took years and hundreds of millions of dollars. It's high-quality, relatable data connecting biology and chemistry. Very hard to replicate.
So data is key. What else?
The talent. Finding and retaining that bilingual team of top-tier life scientists and computational experts is incredibly difficult. Scarce talent pool.
Makes sense.
Then there's just the sheer capital intensity. Enormous upfront costs for R&D, those robotic labs, the supercomputing power like their BioHive 2. Plus, you have to fund years of sustained operating losses.
Right. They're not profitable.
Not even close. And finally, there are cultural hurdles. Skepticism within the traditional pharma world, data security concerns, the black box nature of some AI convincing people it works.
Okay, so if those are the barriers, what's Recursion's specific competitive advantage? Their moat.
Several things contribute. Brand strength, they were an early pioneer in tech bio, and those big partnerships with Bayer, Roche, Sanofi really validate them.
What else?
Cost advantages, potentially. That industrialized approach, 2.2 million experiments a week, should drive down the marginal cost per experiment over time. Economies of scale.
Network effects. Switching costs.
Possibly. High switching costs for partners who deeply integrate the Recursion OS into their own R&D workflows. They become dependent on Recursion's platform and data.
But the core advantage.
It really comes down to those unique assets. The 36 petabytes of relatable proprietary data, the fully integrated Recursion OS connecting the atoms wet lab to the bits computation, and that massive computational scale with BioHive 2. That combination is their key differentiator.
It's fascinating, though. The whole investment case really hinges on this tech platform.
Absolutely. Yet the financial reality today is a pre-revenue company. They're kept afloat by partner milestones and selling equity. Losses are significant and widening.
Which brings us back to that critical question. Can they actually bridge that gap? Can the tech deliver profits before the cash runs out?
That is the million, or rather billion-dollar question hanging over RXRX.
Okay, let's shift gears and look at the people making the decisions. Chapter 2, Management Evaluation.
All right, Chapter 2. Management, always crucial.
So the leadership team, it's headed by co-founder and CEO, Dr. Chris Gibson. Seems like a mix of scientists, medical folks, tech experts.
Yeah, it's that bilingual blend again right from the top. Their track record includes, well, successfully raising a lot of capital.
Definitely good at that.
Forging those high-profile partnerships we discussed.
Right.
And they've pursued a pretty aggressive M&A strategy focused on tech.
Okay, but let's unpack the most telling recent actions. Their response to the challenges in 2025. That seems key.
Absolutely. Facing a tough biotech market, maybe some post-merger complexities with Exscientia, management made a big strategic pivot.
Right. May 2025, pipeline reprioritization. They cut several clinical programs, even some advanced homegrown ones like REC-994.
Framed again as data-driven, focusing resources where science looks strongest.
Then, right after, June 2025, workforce reduction. About 20%, roughly 160 employees.
Yeah, and that was explicitly about cutting the cash burn rate and extending their financial runway, pushing it out towards Q4 2027, they hoped.
So if you connect the dots,
Yeah,
big merger, then almost immediately, big cuts to pipeline and people.
it does suggest a reactive shift, doesn't it? Well, they called it disciplined. The timing makes you wonder if the initial post-merger plan hit some snags. Maybe a pivot born more out of necessity than seamless planning.
Could you see it as just prudent adaptation, though, responding to market realities?
You could argue that too. Tough markets demand tough choices. But it definitely raises questions about foresight during the M&A process.
What about communication and ethics? Seems standard.
Pretty standard for a public company. Investor relations website, SEC filings are all there. They adopted a code of business conduct and ethics back in 2021. No major documented ethical scandals that we found.
Okay, let's talk capital allocation. Where's the money going?
Squarely focused on growth and tech advancement. The lion's share goes to R&D. Expenses there have just skyrocketed from about $135 million in 2021 to over $300 million, $314 million in 2024.
And M&A has been a big part of that spending too, right?
Definitely. The MAM back in 2020. And Cyclica and Valence in 2023, that was $87.5 million, mostly stock. And of course, the huge all-stock merger with Exscientia in late 2024, all aimed at boosting the platform.
Now, critically for investors, share buybacks, dividends.
Zero history of share buybacks. In fact, the opposite, they've issued new shares, leading to significant dilution. About 54.7% dilution in the past year alone.
Ouch. And dividends.
Never paid one, no plans to. Which is totally normal for a clinical stage growth company. They need every penny for R&D.
So that leads to return on invested capital, ROIC. I'm guessing it's not pretty.
Not pretty is an understatement. It's deeply negative. TTM ROIC was minus 48.30%.
Minus 48%. What does that actually mean?
It means for every dollar invested in the company, they're generating an operating loss of about 48 cents.
Wow. How does that compare?
Well, other biotechs are often negative too, but maybe not that negative. Allogene was meant at 11.6%, Sana nated at 6.4%. It just highlights this isn't a traditional business optimizing returns right now. It's a venture capital style bet.
Which, again, raises that crucial question.
Yeah.
If you're burning cash this fast, where does the money come from, and what does it mean for you, the potential investor?
Exactly. That leads us right into the financials.
Chapter 3, Financial Analysis.
Okay, Chapter 3. Let's follow the money.
So the basics. Market cap around $2.05 billion at that $4.70 share price. Small to mid-cap territory.
Got it.
Revenue trends, we see big growth, yes. But remember, it's from a tiny base and entirely from those collaboration milestones. No product sales.
Right. Grown from under $4 million in 2020 to TTM revenue around $64.6 million. Decent top-line growth percentage-wise.
But, and this is the kicker, what kind of profit is that revenue generating?
Profit. That's where the story changes dramatically. Margins are, well, deeply negative.
Profit was negative. Costs exceeded revenue.
Negative $2.27 million TTM gross profit. Operating losses were huge, almost $650 million TTM. That gives you an operating margin of, wait for it, minus 1,000%.
Minus 1,004.88%. That's staggering.
It really underscores the sheer scale of investment versus current revenue. Net loss TTM was also around $649 million.
Okay, what about free cash flow? How much cash are they actually burning?
Tells the same story. Consistently, increasingly negative. Went from burning about $50 million in 2020 to burning almost $400 million, $394 million in 2024 TTM. Accelerating cash burn.
Which just screams reliance on external financing, right? Selling stock or hitting those milestones.
Absolutely. It's the only way to keep the lights on at that burn rate.
So financial stability, earnings, consistently negative.
Consistently negative, and the losses have widened significantly each year. From an $87 million loss in 2020 to a $463 million loss in 2024. That growing loss is a primary risk factor.
But their balance sheet looks okay. Debt.
Very little debt. Debt-to-equity ratio is tiny, just 2.5%. So the balance sheet looks strong, but that strength comes from equity raises, not from operational health.
It's basically their cash pile from selling stock.
Exactly. Which, after those cost cuts, they project gives them a runway into Q4 2027. Their current ratio is also strong, 3.58, showing good short-term liquidity. Again, thanks to raised cash.
And dividends, as we said, Not applicable.
Nope.
Okay, valuation. This is where it gets really interesting. PE ratio.
Meaningless. NA. Because there are no earnings.
So we look at price to sales, PS.
Right. And Recursion's TTM-PS ratio is 26.18.
26. How does that compare?
It's exceptionally high. The biotech sector median is around 3.5. So Recursion is trading at over 7 times the median PS.
Wow, that screams high expectations and high risk. Price for perfection, or at least for major disruption.
Absolutely. It signals extreme market optimism baked into the price, detached from current fundamentals. Huge valuation risk there.
What about trying to find an intrinsic value, like using a discounted cash flow DCF model?
You can try, but for a company like Recursion, a traditional DCF isn't really about finding a precise value. It's more of a scenario modeling exercise, meaning the range of outcomes is incredibly wide, almost binary. Bull case, multiple drugs succeed, platform is validated, value could be multiples of the current price. Bear case, platform fails, drugs fail, value trends towards liquidation value, basically just the cash they have left.
So trying to run a DCF requires some pretty heroic assumptions.
Totally heroic. You'd need to plug in maybe 40–50% revenue growth for a decade, assume they eventually reach 15–25% long-term net profit margins.
Which no one knows if they can achieve.
Exactly. And you'd have to use a very high discount rate, maybe 15–20%, to account for the extreme risk involved. It's highly speculative.
So given all that, the business model, the tech promise, the brutal financials, the valuation, what does it mean for Recursion's place in the market? How are investors reacting?
Great question. Let's transition to part 2 and really dig into that market sentiment and ownership picture.
All right, part 2 it is. Let's dive in. Part 2, market, ownership, risk, and conclusion. Chapter 4, market sentiment.
Okay, chapter 4. How does the market feel about RXRX?
Well, Wall Street analysts, the consensus rating is technically buy, but you have to look closer.
Always have to look under the hood with consensus ratings.
Right. A lot of analysts, maybe 60–80%, actually rated a hold. The average price target is somewhere between, say, $6.50 and $7.
Which implies decent upside from that $4.70 reference price, 37–49% maybe?
It does, but look at the range of those targets. It goes from a low of $3 all the way up to $10.50. That's a huge spread.
Reflects massive uncertainty among the analysts themselves. No clear agreement.
Exactly. And it's worth noting some big firms like Morgan Stanley and Needham actually cut their price targets in 2025 after that restructuring.
Okay, that's telling. What about the general news flow, the media tone?
Mostly negative, honestly. Dominated by that strategic pivot, the program cuts, the 20% layoffs. The narrative focused heavily on the high cash burn.
Any positive news?
More sporadic. Things like hitting a small $7 million milestone with Sanofi or releasing a new computational model like Boltz 2. But the restructuring news kind of overshadowed that.
Okay, let's look at market indicators. Short interest.
This is where it gets really stark. Short interest as a percentage of float, exceptionally high. 29.20%.
Wow, nearly a third of the float is shorted. That's massive.
Over 122 million shares shorted. It indicates a really significant, deeply entrenched, bearish sentiment. A lot of smart money is betting the stock will go down further.
That raises a huge red flag. What about the days to cover?
Also high, between 4.6 and 6.6 days, meaning it would take that many days of average trading volume for all the shorts to cover their positions, suggests it's not just a quick trade, it's a conviction short for many.
Okay, technically, moving averages.
Also bearish signals. The $4.70 price is below its 50-day moving average, which was around $5.44. That's negative short to medium-term momentum.
And the 200-day?
Well below its 200-day moving average, which is up at $6.09. That confirms a more sustained, longer-term downtrend.
So you put it all together. Analyst uncertainty, negative news flow, massive short interest, bearish technicals.
It paints a very clear picture of a battleground stock, doesn't it? Where you have some institutional bulls maybe clashing head-on with profound market skepticism.
Absolutely. A real tug-of-war going on.
Chapter 5. Ownership structure.
All right, Chapter 5. Who actually owns this battleground stock?
Institutions dominate. They hold about 68% of the outstanding shares. So there's significant conviction there from large money managers.
Which kind of institutions?
Heavily weighted towards growth and tech-focused firms. Think Vanguard, ARK Investment Management, BlackRock, Bailey Gifford, SoftBank even. Big names known for betting on disruption.
But what have they been doing recently? Buying, selling.
It's actually pretty mixed. Some have increased their positions recently, others have trimmed. And interestingly, some major healthcare-focused funds like RA Capital and Deerfield actually liquidated their positions entirely.
That's notable. Healthcare specialists getting out while tech growth funds hold or add. Interesting divergence.
Very. Now, let's talk insiders, management directors. They hold about 4% total, with CEO Chris Gibson owning around 1.6%.
Okay, 4% is meaningful. What are they doing with their shares?
Okay, let's unpack this because the pattern is, well, it's stark and consistent. Selling, with zero corresponding open market buying.
No buying at all. Just selling.
That's what the record shows for the past 5 years for CEO Gibson. Dozens of sales, not a single open market purchase reported. In the last 6 months alone, he sold nearly 800,000 shares for over $4.3 million.
Wow. And other executives.
Also net sellers, following the same pattern. So what does this mean for you, the listener? I mean, this is a pretty significant red flag, especially for value investors, wouldn't you say?
It absolutely is. Management might be saying all the right things publicly about confidence in the future, but their personal financial actions, consistently selling shares and never buying on the open market, suggest maybe a different level of personal conviction, a disconnect.
Yeah, actions speak louder than words sometimes. What about ownership concentration?
Highly concentrated. The top 13 holders own over half the company, 51%. The top 25 own about 65%.
And that concentration leads to?
High volatility. When a few large funds decide to rebalance their portfolios, maybe trim their position, it can have an outsized impact on the stock price because they own such large chunks.
Makes sense. More potential for big swings.
Definitely adds another layer of risk.
Chapter 6, Risk Assessment.
Okay, Chapter 6. Let's pull all the risks together. A SWOT analysis might be helpful here. Strengths, weaknesses, opportunities, threats.
Good idea. Let's start with internal strengths. What are Recursion's core competencies?
Number one has to be that proprietary technology and data mode, the Recursion OS, the 36 petabytes of relatable data. That's hard to copy.
Agreed.
That's validating strategic partnerships we talked about. Bayer, Roche, Sanofi. They provide funding and credibility.
And the scale.
Right, that scalable, industrialized approach, millions of experiments a week, potential for economies of scale down the road.
Okay, now the flip side. Internal weaknesses. What are the big limitations?
Financial sustainability, or rather the lack thereof, that high cash burn, the widening losses, it's fundamentally unprofitable right now. That's the elephant in the room.
Which leads directly to?
Dependence on external capital. They need those milestones to hit, or they need to keep selling stock. Makes them vulnerable to market sentiment shifts.
And the biggest weakness of all, perhaps?
Still no commercial products. The entire value proposition is speculative until they actually get a drug approved and generating revenue.
Okay. External opportunities. What's the upside potential in the market?
Huge opportunity in the growing adoption of AI in drug discovery. If they can prove their platform works, more partnerships could follow.
Addressing big medical needs.
Exactly. Targeting areas like oncology and rare diseases means addressing high unmet medical needs. Successful drugs there have massive commercial potential.
And the platform itself.
It's versatile. There are opportunities to expand the Recursion OS into new therapeutic areas, maybe even beyond traditional drug discovery eventually.
All right, now the external threats. What challenges are lurking outside the company?
Competition is a big one. Intense and evolving, both from other AI biotechs and from big pharma's internal efforts.
Regulatory hurdles.
Definitely. Stringent and still uncertain rules from the FDA around AI-generated data. Could cause delays, increase costs.
Tech obsolescence.
Always a risk in tech. What if a competitor develops a fundamentally better algorithm or approach? Recursion needs to keep innovating just to stay ahead.
And the biggest threat for any biotech?
Clinical trial risk. It's binary. Drugs either succeed or fail in human trials. Failure of key candidates could be catastrophic for Recursion. That's the inherent gamble.
What about macro factors, like interest rates?
High interest rates are brutal for companies like Recursion. Increases their cost of capital, makes investors more risk-averse, harder to raise money, really hurts speculative, cash-burning assets.
And hypothetically, geopolitical stuff, like tariffs.
Yeah, hypothetically, if the U.S. imposed new tariffs in 2025 on, say, lab equipment or computing hardware, that could directly increase Recursion's costs, worsen the cash burn, maybe disrupt their supply chains.
Yeah.
Adds another layer of external risk.
Okay, we've covered a lot. Strengths, weaknesses, opportunities, threats. Let's try to synthesize this.
Time to bring it all together.
Chapter 7, conclusion.
Chapter 7, the final wrap-up.
So let's summarize the bull case first. What's the optimistic view on Recursion?
The bull case is really a pure play bet on technological disruption. Bulls see that formidable competitive moat, The data, the labs, the supercomputer.
They believe recursion can fundamentally change the economics of drug discovery.
Exactly. Make it faster, cheaper, more successful.
Hmm.
And those big pharma partnerships are seen as validation that they might be onto something.
And if even one drug makes it through.
It could validate the entire platform model and unlock absolutely immense value. That's the dream.
Okay, now the bear case. What's the pessimistic view?
The bear case is grounded squarely in today's reality. No commercial products, widening losses, deeply negative free cash flow, an unsustainable cash burn rate,
Heavy dependence on external capital.
which is always risky. Plus, that recent pivot-cutting programs laying off staff, bears see that as a signal of significant challenges, maybe desperation.
And the valuation.
Bears point to that PS ratio of 26, calling it detached from fundamentals, way above the sector median.
Plus, those red flags we discussed.
Consistent insider selling with no buying. Exceptionally high short interest. The stock's long-term downtrend. Bears see a highly speculative venture priced for a perfect outcome that's statistically unlikely.
So, valuation summary. Impossible to pin down a precise intrinsic value.
Pretty much impossible. As we said, it's a wide bimodal distribution. Could go towards cash value if things fail, could be multiples higher if they succeed. DCF is just a speculative exercise requiring those heroic assumptions.
So, the concluding outlook.
Recursion Pharmaceuticals is a classic high-risk, high-reward disruptive technology play, specifically in the tough world of biotech. That $4.70 share price reflects a market in deep, deep conflict.
Trying to balance that long-term vision against very real near-term risks.
Precisely. You're not investing in a proven business here. You're making a venture capital-style bet on a paradigm shift. For traditional value investors, the risk profile and the current valuation are, frankly, exceptionally challenging.
So, the investment thesis really rests on faith.
You could say that. Profound faith that this technological platform, against very long odds, will eventually create a profitable, sustainable business in the future. It's all about the future potential, not the present reality.
So, you've seen the full picture now. A company with truly revolutionary ambition, backed by some serious technology.
But battling just daunting financial and clinical realities day to day.
Recursion Pharmaceuticals really does embody that high-stakes gamble of tech bio.
It's a perfect example.
And maybe it's a reminder that sometimes, the biggest promises come with the biggest questions.
And the answers aren't here yet. They're still being written in the lab, in the market, and crucially, in those upcoming clinical trials.
Our mission here, as always, is just to help you cut through the noise, get truly well-informed, maybe have those aha moments, and just gain a deeper understanding of these complex companies and topics.
Hopefully we've done that today.
Thank you for joining us on this deep dive. Until next time, keep exploring, keep questioning,
And keep learning.